First model we're going to be looking at here is what we refer to as the discount dividend model. And the way that this works is that we know that as a company, the way that we get money here, the way we get a higher return, is that we're going to put this into, a time frame. Okay? All right? And we're basically going to say, all right, over a period of time, I'm going to be receiving a dividend, right? I receive a dividend in year 1, I receive a dividend in year 2, a dividend in year 3, a dividend in year 4, and I'm receiving dividends out until year T, which T here we're going to denote as an infinite time period, because we know that a company does not have a fixed period of time until they're going to die. We don't know when a company is going to die. They don't have a finite life. Okay, so the company can theoretically live forever. Okay, so what we're taking here is that we're taking the value of all of these dividends that we have, and then we're just bringing them back. We are discounting those. Okay, that's where we get this from. We are discounting the value of our dividends. Okay, so we're taking a very simple model based off of our time value of money formula, okay, which basically is just showing us, hey, we have this formula that looks the same that we've done every one of these times. We have D1, which we're going to discount back by that rate to the first power. We're going to have D2 that we're going to discount back 2 periods. We have D3 that we're going to discount back 3 periods. Plus, then we get all the way out here to, we go out to infinity, essentially, is that we have this to the 1 plus r to the infinite power, right? So we're taking the value of our dividends coming from here in time 1, running us out for infinite time periods, and then we are taking the value of those dividends and we're bringing them all right back to our present value today. Okay? So this formula here, when we do it in this regard, is that we have our price today, P sub 0. So from t equals 1 until infinity, we have the expected value of our dividend in that time period, right? So we're starting at time period 1 here. So this is going to be D1, D2, D3, etc. is going to be on the top. And that's going to be divided by the 1 plus r to the t power. Okay, same thing we were looking at here. This is basically a fixed payment, cash flow, fixed payment. And you can look at this as almost like an annuity with infinite number of payments. And this is just putting us into here. Okay? The way we simplify this is a very simplification part, is that we actually take the value of our dividend and we divide that by our rate of return. Okay? This here we've seen before, and this here is our perpetuity. Okay? Because that's what this is, right? We are receiving perpetual payments. We're receiving a dividend payment every single year out for infinite number of times. That is a perpetuity. That is the definition of a perpetuity. Okay? So we have that d divided by r. If we're going to graph what this looks like, okay, we would have our t is on our horizontal axis, our time period. We'd have the dollar on the vertical axis, just the amount. And we would have basically a dividend amount that runs out just like this. We have a constant dividend. Okay, so we have a constant dividend. But then we take our present value, because every time we go back, let's say this is t equals 1, t equals 2, t equals 3, is that the farther out in time we go, the lower the present value is. So what we have here is that we have a downward sloping curve that looks something like this. We fill in this part down here, and this actually tells us the price today of the stock. Because when we track this down here, is that this is going to tell us what the value of the first payment is. This is going to tell us what the value of the second dividend payment we received, and on and on and on. Okay? But the important part here is that we see that the dividend payments are flat. They are constant across time. Okay? Is this realistic? Is the basic question. And it should pop in your mind that, no, this is not realistic, right? Why is this not realistic? Because do we expect a company to pay out the same amount of money, pay a $2 dividend between now and the next 500 years? In 500 years, they're going to be paying $200? No, probably not. We're going to expect them to be paying at least a little bit more, right? Because we want this company to grow. All right, now we're going to start incorporating growth rates. Okay, and growth rates are very important because when we look at our dividend payments, is that we expect dividends to grow. Okay, we expect all the companies that we're looking at, we expect them to grow, and we denote that growth by being G. Okay, so G is equal to our growth. Okay, this is our growth rate. Okay, and when we do this, is that we're going to put this into a similar way that we did with our discount dividend model, Basically, remember it was, we took our dividend divided by 1 plus r to the t. So we're saying the first d1 plus d2 divided by 1 plus r squared plus blah, 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 out to, we then want to incorporate into this some of our growth rates. Okay, so if we're taking a value, a starting value, and then we're adding on a growth rate, is that we're going to do this similar sort of thing here. We're going to put 1 plus g out here. Okay, and this is, you can think of this as basically being a compounding interest sort of situation. We take that beginning value of our dividend. Let's say we take a dividend of $100, and we're growing at a 2% rate. We take that 100 times 1.02, right, which we know is going to be $102. Let's take this, so this is going to be D0, okay? So we're going to change those values here to D0 because, right, is that we're going to take this D0. Let's say D0 here is equal to that $100. And so we know that D1 is now going to be $102 if it's growing at 2%. Okay, if I want to find out what D2 is, what do? I take D1 and I multiply that by 1 plus my growth rate, right? Which is going to be the 102 times 1.02. Okay? And on and on and on. We're going to do this out for infinite numbers of time periods. We can change this here a little bit by basically saying, all right, if we're going out 2 time periods, right here we're going out 2 time periods, is we can take this 1 plus g and we can square that. Okay? Because it's compounding now, this growth rate is compounding now 2 periods. Our r is compounding 2 periods, our growth rate is compounding 2 periods. And we can even put that out here into the infinite time period, right? Because we are growing those dividends. Simplify this process a little bit by moving this into a similar form as a perpetuity. Okay, so we can take our price today, and we can say that that price today is equal to d sub 0 times 1 plus g, okay? And then that is divided by r minus g. And then we simplify the g's out of here, and because we know that this top part here, d0 times 1 plus g, this part here is equal to d1. It's taking the value of our dividend at time period 1 and dividing it by the rate of return required on this investment, and we're taking off of that the growth rate. Okay, that growth rate is an important factor here, right? Because we are taking off the amount of our discount. Right, because that rate of return that we're seeing right here, that is the amount of our discount. All right, let's say we're looking at a company. We're looking at ABC International. Okay, and you're trying to figure out if this is a fairly valued company or not. Okay, and you know that you have a dividend today. They just paid a dividend in the amount of $2.50. Okay, and the rate of return on, you look at other investments that are similar, and let's say that there's a rate of return on similar investments of 12%. That's enough compensation for risk. Basically, you wouldn't buy this stock unless you were going to get a 12% return on your money. And then we're looking at a growth rate. Let's say this is a sort of a faster growing company where we have a 4% growth rate. Okay, so we put this in to figure out our value, our price today. This is going to be, we have to put in D1 divided by R minus G. Okay, now the first thing we have to do is that, well, one, do we have enough information in this question? Yes, we do, but we can't just plug everything into this part right here. We have to find out what D1 is. We find out D1 basically by taking D0 times 1 plus G divided by R minus G. Okay, so this would be 2.5 times 1.04, right? It's a $2.50 dividend that we received today, multiplied by that 4% growth rate, and that is then divided by our R, which is 12%, minus the 4% on the growth rate. So this tells us our price on this stock is going to be $32.50. Okay? We have a price $32.50. Okay?